Hello there. Welcome to the Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Air Canada CEO Michael Rousseau will retire by the end of September. Now, this follows backlash after he released a condolence video for victims of the LaGuardia airport crash in which he did not speak French. The company says the search for a new CEO is underway and that the ability to communicate in the language will be considered in the decision. U.S. President Donald Trump is threatening Iranian energy sites if the Strait of Hormuz is not reopened soon. In a post on social media, Trump said the U.S. would respond by, quote, blowing up and completely obliterating Iran's power plants, oil wells, and Karg Island, the crucial oil facility, if the strait remains closed. Those remarks come after a brief pause in attacks on energy infrastructure as the two countries held talks. Bloomberg says the federal government is working with Quebec to prevent the closing of Canada's only copper smelter. Now, that's after the owner, Glencore, threatened to shut it down over new pollution requirements. Last month, the company suspended plans to invest nearly $1 billion US in its Quebec operations after talks on reducing arsenic emissions collapsed. Quebec is now proposing legislative changes to address some of Glencore's concerns. And there's a look at U.S. stock futures. They're up after a brutal Friday for stock markets. And let's have a look at the TSX and see how it ended Friday. Both the Canadian and U.S. markets are down about 7% so far in March. And let's have a look at oil this morning. The Wall Street Journal says President Trump, and oil holding above $100 there, you can see. The Wall Street Journal says President Trump is weighing a mission in which U.S. forces would go into Iran and physically extract almost half a ton of uranium. But obviously that brings major risks to U.S. troops. We're seeing a familiar pattern in U.S. equities. Every Friday since late February, the S&P has sold off, only to bounce back on Monday and actually finish higher. So let's see how this Monday is shaping up. We're joined by Bloomberg macro strategist Cameron Kreis. Cameron, thanks very much indeed. Fascinating topic. So, I mean, one interpretation, I guess, would be people heading into the weekend, they just want to get positions off their desk and calm their minds.
Yeah, I think that's absolutely right. I mean, given the nature of this conflict and the fact that the violence, as it were, is two-way, as indeed we saw this past weekend with Iran's strikes against aluminum smelters. And what have you. It's kind of natural that particularly fast money wants to sort of clear the decks and de-risk after the weekend. And what's really interesting, actually, is that every Monday, and in terms of our time zone, every Sunday evening when S&P futures open again, Asia takes them lower. But that dip has been bought every single time as the street kind of re-risks up on the Monday. So, it kind of feel like Bill Murray in Groundhog Day, where we're kind of, reliving the same trading pattern over and over and over again. And frankly, I was a little surprised to see Asia mark S&P futures lower at the open last night because, they've tried it 5 times in a row. And it hasn't worked. Hasn't worked since February. So, and it doesn't look like it's working again today.
And oil, you note that oil is trading near its highest since the conflict began.
Yeah, well, in fact, if it closes sort of where it is now, it'll be the highest since the summer of 2022.
Wow.
Which was obviously a very different time in terms of the inflation narrative, the broad inflation narrative. not to get political, but the inflation does have consequences for politicians, whatever people on social media might say. So, that has been seen as a potential trigger point for the White House to sort of look to de-escalate or to withdraw. And the reason for Trump extending the deadlines, the negotiating window with Iran before the promised strikes on energy infrastructure and what have you. But by the same token, when you see that troops' boots are they're not on the ground yet, but they're on the deck of ships, as it were, that doesn't necessarily raise a lot of confidence that this thing is going to end quickly. And I think what's the most troubling thing for many people is that the people who have, many, not all, obviously, but a lot of the people who were pronouncing a month ago that this was going to be a very short-lived conflict, with confidence, well, it hasn't been short-lived, and right now there's not much end in sight. So I think the honest appraisal is that there's a lot of uncertainty out there, which, squaring the circle, is why people are so eager to de-risk on a Friday to sort of eliminate some of that gap risk, some of the uncertainty, so that at least they can enjoy their weekends.
Cameron, thank you very much indeed for joining us today. Have a great week. That's Cameron Kreis, Bloomberg macro strategist. Let's stick with oil trading above $100 today. We're joined by Stephen Shork, principal of the Shork Report. Stephen, thanks very much for joining us at short notice as well. The oil price discounting, it looks like more violence in the Persian Gulf for quite a while.
Yeah, absolutely. So I think anyone who came into this and saw what has transpired over the last 4 weeks, if you were to think, oh, this is going to be a short-lived war, Andrew, they're not living in the same world that you and I are. This is a much different operation, and I think the administration has done a horrible job of communicating expectations on how long this was going to take. Therefore, and why I'm going there, and I went a little bit political there, is because as an oil trader, oil analyst, you are living off of every tweet, every headline that is coming out of the market. So we saw a lot of volatility in those first 3 weeks. Last 4 weeks, the fourth week, last week, we did pull back. Now, NYMEX WTI, commodity markets like to mean regress. So when we just modeled out the path for the next 4 weeks for the current prompt market for May delivery, we're looking at a median price of potential outcomes of about $93 a barrel. Our first standard deviation envelope, the ceiling, is $102 a barrel. So we got up to over 103 in overnight trading. We're back below, I believe, 102 right now. So we're right there. So as a quant, as a trader, what this is telling me is the market is settled in to a reasonable trading range, and we're just now waiting for that next catalyst that could send us significantly higher. Because once we go beyond $102 a barrel, a sustained trading pattern above that, then the potential of the next level is significantly higher above there.
It's interesting, yeah. There's speculation that U.S. troops might go in physically to snatch Iran. Well, the Wall Street Journal says President Trump is weighing snatching the uranium. But people will remember, old guys like you and me will remember 1980, so-called Operation Eagle Claw, and they tried to put in choppers under President Jimmy Carter to rescue the hostages, but that operation ended in failure.
Yes, I mean, and that's fair. And yes, I do remember that very well. But this is not the same military it was under Jimmy Carter's 1979 presidency. I mean, we're looking at a military that pulled off Osama bin Laden, pulled off the Maduro execution. We're talking about a military that is at the peak of its game. I'm not advocating. Please don't take this as I'm advocating boots on the ground and we're going after this. But we've seen how the U.S. military has responded over going back to what's the last roadmap we had for this? The first roadmap that was 1990 when Iraq invaded Kuwait. So the big difference between then and now is in 1991 when the war began, we had a clear roadmap. That roadmap was simply get Iraq out of Kuwait. Once that occurred, the war was ended, and that's how the market reacted. And the market sold off extremely fast as soon as that war began. So now we have a situation where what is the roadmap? Is the roadmap ending Iran's nuclear capability? Is the roadmap regime change? We simply don't know. That is, when I say we, the market simply doesn't know what that roadmap is. So we're still trading on a significant amount of volatility. And what we have, Andy, is a bifurcated market. We're talking about oil at $100 a barrel. Well, last month, oil, where it counts, was $170 a barrel, and that is in the Asian markets. And those are the markets most vulnerable to the bottleneck that we're seeing. Those are the markets that are short oil, and those Asian refiners are bidding for oil at significant premiums to what you and I comment on, the NYMEX WTI contract or the ICE Brent contract. So what has transpired now, Andy, over the past week is we're starting to see that panic now spread out. So I can put oil delivered into Houston out of my West Texas production. I can put it into Houston and sell it on the global market and still net an $8 profit. So what we're going to start to see now, Andy, over the next couple of weeks is a significant bid that U.S. oil in the Gulf Coast is the cheapest barrel in the world. So there's a massive arb, whether you're a European refinery in Rotterdam or you're an Asian refinery in South Korea. You are bidding for these Gulf Coast barrels. So at this point, that is the market we really want to watch for, is the spread differential between Gulf Coast barrels, i.e. NYMEX WTI, which is trading right around $102 a barrel, and the foreign price of oil. So I suspect in the weeks ahead, U.S. oil prices, when we say $102, that is cheap relative to the rest of the world. I would suspect that price to increase to catch up with the world. So what I'm saying, Andy, is we're looking at oil. If we do not see any sort of resolution, and by resolution, I mean a resumption to flows of oil through the Strait of Hormuz. I'm not a military guy. We just see more oil hit the Asian markets. Without that, we're looking at oil prices higher for much longer.
It's interesting, yeah, you refer to the disconnect between the paper market, the so-called paper market, the futures, and what's happening in the real world. And RBC saying, oil executives say this is not sustainable, this gap.
Yeah, absolutely. So what we're looking at right now, and that's what happens, nature abhors a vacuum, traders abhor an arbitrage. So that arbitrage, which, as I said, for barrel West Texas oil delivered into Houston at about $7 to $8 premium above the global price, you're going to see that arb close. So what does that mean? You're only going to close that arb two ways, Andy. Demand destruction. So take that demand out. And by demand destruction, of course, we're talking about significant economic contraction, i.e. recession. Or you're going to see that supply, that price rise to meet the market. I'm going, at this point, the price will rise to meet the market. So at $102 a barrel, which is where we've mapped out for the next 4 weeks, our next tranche, our next ceiling is now for WTI, $133 a barrel. And that would put it more akin to where the Asian markets and the seaborne markets are trading at this point. So certainly I expect that vacuum to suck prices higher. That gets us to $133 a barrel over the next 4 weeks. Again, assuming we don't see any sort of resolution to the current conflict.
Sorry, give us that number again before I let you go.
133 NYMEX WTI over the next 4 weeks if we do not see any sort of resolution to the conflict right now.
Wow, $130 plus for WTI. Thank you very much indeed for joining us today, Stephen.
Great to be here, Andy.
Stephen Shork, principal of the Shork Report. Coming up, NDP's Avi Lewis has secured an easy win in a leadership result that could ultimately shape Canada's economic direction. That's ahead. Welcome back. An eco-socialist has cruised to victory in the NDP leadership contest, winning on the first ballot at the federal NDP convention in Winnipeg, with a win of 54% of the ballots cast. He's been the party's interim leader since Jagmeet Singh resigned. That's after the NDP was resoundingly defeated in the last federal election and actually lost party status. Let's get more from CTV's Scott Hurst. Scott, just remind us, who is the new leader?
Good morning, Andrew. A 7-month leadership campaign has culminated in Avi Lewis becoming the new federal NDP leader, as you mentioned, defeating his rivals on the first ballot, collecting well over half of the members' support with nearly 40,000 votes from the more than 70,000 cast. Taking the stage to chants of his name, Avi Lewis saying our party is back and our tent is growing. Lewis, a Vancouver-based filmmaker and author, had run twice as a federal NDP candidate unsuccessfully in 2021 and 2025, pitching himself as a leader who can bring the NDP to form government that, quote, serves the many, not the money. In his campaign platform, Lewis proposed to block any new pipelines, impose a wealth tax on the 1%, implement a national rent cap, and create public options for groceries. Now, we are expecting to hear more from the new federal NDP leader. He's holding his first press conference at about 10:30 Eastern time this morning, Andrew.
And, of course, he's a former host on City TV, CBC, CTV, former broadcaster, born in 1967. So the NDP, though, at a low ebb right now, with only 6 seats in Parliament.
Andrew, there's no question it is a challenging time for the federal NDP, but now with a new leader in place, the rebuilding can begun. The NDP, as you mentioned, holds just 6 seats in Parliament. Of course, Lewis himself would need to win a seat in Parliament, and as a result of the last election, have lost official party status. So really limiting the ability of the party to use the parliamentary mechanisms to better hold the government to account. And so the big question is, what's next? There is, of course, a fight for national relevancy, but also some rebuilding of bridges internally between the federal party and some provincial NDP parties. So despite the strong mandate from members, celebrated by many, including Manitoba Premier and NDP Wab Kinew, others have expressed disappointment. Alberta and Saskatchewan NDP putting out statements of their own, saying ultimately his views run contrary to the party's working class roots. So, Andrew, a lot of work ahead for Avi Lewis as he now takes the helm of the federal NDP.
I should clarify that he was a host, or he worked on CP24. But yeah, interesting. And also a documentary filmmaker, and also a former host of an Al Jazeera documentary series. Thank you very much. What a story. And I imagine he's going to come out swinging, Avi Lewis, in the debate over pipelines and other issues. Scott Hurst of CTV News joining us there.
Thanks, Ed.
We have lots more coming up on the Open. Stick with us. Up next, the Air Canada CEO is calling it quits amid something of a firestorm over his avoidance of French in a recent condolence message. We'll be right back. Air Canada CEO Michael Rousseau is set to retire by the end of September. Now, that's after a backlash after he released a condolence video for victims of the LaGuardia airport crash, in which he avoided French. Let's get more from Bloomberg's Montreal bureau chief, Mathieu Dion. Mathieu, thanks very much for joining us. This thing really gathered pace, didn't it? He was under fire, but now he's stepping down.
Exactly. So what we saw last week was somehow unprecedented. So he made this video in English only. He was rushed to go to LaGuardia just afterwards. So they made some captions in French. But that sparked outrage in Quebec because back in 2021, he made a speech only in English in front of business leaders in Montreal when he was appointed CEO. And he essentially said afterwards that he's proud of being able to live in Montreal for more than a decade without having to speak French. So that sparked outrage back then, and he had to apologize. And since then, Quebecers were expecting that he would learn a little bit of French. And it seems that he did not. So when he did this video only in English, there was a lot of frustration, especially that Air Canada is subject to the Official Languages Act. You had Mark Carney stepping up and saying that that you have a responsibility at Air Canada to always communicate in both official languages, regardless of the situation. Then you had the National Assembly of Quebec passing a motion, 92 votes against 0, saying that he should step down. The Canadian Parliament passed a motion to have him appear before the Languages Official Committee before May 1st. So there was a lot of things going on, and you can imagine that there were several board meetings over the past week because of the accident at LaGuardia. And then today, Air Canada had to release its annual meeting notice to shareholders. And what's in that? There are some documents, and you have Michael Russo's compensation in there. And his compensation in 2025 was more than $13 million, up 5-6% from a year ago. So there was a lot of things going on. And then apparently the company, the airline, was doing a search process to find a new CEO since January. There was a succession planning in place that's been in place for 2 years now. Mm-hmm. So that was already in place. And we can believe that what happened last week and the annual notice sent to shareholders today, all this together pushed Michael Russo to announce that he would retire. He's 68.
It's interesting. I mean, he got into hot water over this thing before. You think his advisors would have tipped him off? It sounds like he was badly served here.
But yeah, that's an important question you're raising. That someone told him, like, maybe you should at least say a few words to the families, because one of the 2 pilots killed in the air crash was a Quebecer, Antoine Forêt. So maybe he was not well advised. Maybe he took the decision by himself to just do it in English entirely. We don't have the answer to that. But clearly, it sparked a real PR crisis at Air Canada, and it was a mistake. And even La Caisse, the Caisse de dépôt, the pension fund, said last week that the statement should have been done in both languages. So you have the Caisse, that's a large shareholder in Air Canada. You have all the public backlash, so probably that all this together pushed him to the exit.
Mathieu, thank you very much indeed. Mathieu Dion, the Bloomberg Montreal Bureau Chief. Let's have a quick look at the U.S. futures as we count down to the opening bells. As Cameron Kreis pointed out earlier, the market has been setting this pattern over the past couple of months, selling off Friday and then often bouncing back on Monday. So it looks like we could get a marginally higher open today. But remember, in March, the stock market is down about 7%. We'll be right back. Okay, let's get trading underway for the week. And there are the opening bells. At the NASDAQ, United Airlines Holdings and Make-A-Wish are ringing the opening bell. They're celebrating World Wish Month. And in New York, it's women in financial markets doing the honors. It's time for the first 50. Time to get trading underway. Let's see how the big North American benchmarks are doing right now. The TSX actually rallying to begin the session, and the S&P and NASDAQ up, but it's been a miserable month for investors so far. And of course, with oil above $100 US right now, there may not be much prospect of relief in the near term. However, markets recovering somewhat from their sell-off on Friday today. Let's check in on some stocks of interest. Air Canada CEO stepping down after issuing a message of condolence in which all he said was bonjour and merci in terms of using French, and then stuck to English otherwise. And he is going to be departing by the end of Q3. Let's have a look at Aecon here, because two brokerages, ATB and BMO, saying this stock is a hold. ATB resuming coverage at a hold, and also BMO resuming coverage, both citing the valuation of Aecon and other construction stocks, or certainly ATB is, saying they're trading at significantly higher multiples than historically. And of course, Aecon has been propelled in part by its holdings in the nuclear industry. Ontario set for massive spending on nuclear energy. And Vermilion getting an upgrade, still with ATB. ATB moving that stock up to a buy, and the stock is higher today. Of course, we have seen oil moving above $100. That's good for energy producers. ATB citing valuation and a forthcoming free cash flow uplift. Let's check out some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Thanks very much. There is a big takeover in catering or institutional catering.
There is a big takeover, and it's a big move lower in the shares as a result. U.S. food distributor Sysco, this is the company that is spending, it's going to raise about $21 billion worth of debt to buy a privately held restaurant company called Jetro Restaurant Depot. So $21 billion worth of debt, enterprise value is $29 billion. So it is a huge deal. And investors not really reacting very well to it so far. The stock is down, looks like 10% right now. It was down about 7% in the pre-market session. That makes it the worst performing stock in the S&P 500. Definitely something worth watching today. The company, when it came out with this announcement this morning, put a little bit of language into the announcement saying that they were going to defend their credit rating, embark on a few kind of initiatives to try to defend that credit rating, which is about 2 notches above junk right now. So $21 billion worth of additional credit that it's going to raise to close this deal. Doesn't look like the investors so far are all that pleased.
Okay, and CrowdStrike getting an upgrade, a big player in the data center boom.
Yeah, that's right. And it's one of these cybersecurity companies. We discussed this one last week because this has been one of those companies that has been hit hard by the potential for AI. And specifically last week, it was this new Claude Anthropic model, which can do a lot of cybersecurity, applications, which has weighed on these shares. Now, Wolf is out this morning. Wolf Research is out saying that AI will actually be, over the long term, a driver of additional cybersecurity demand. And so this stock should be getting maybe a little bit better treatment than it has so far. Got a little bit of an upgrade at Wolf this morning. And this company is now seeing a $450 price target on the stock. That's about a 22% increase from the price before it started trading today. The stock is up so far. Worth watching over the course of the trading day.
Jeff, thank you very much indeed.
Thank you.
Jeff Morgan. Okay, stocks staging a rebound this morning. However, they hit their lowest since August at the end of last week. Stick with us. We have seen something of a rally in the markets today. However, the U.S. benchmark slumped to an August low at the end of last week. U.S. President Donald Trump said the U.S. is in talks with what he calls a new and more reasonable regime in Iran. However, he also said that military strikes on Iranian energy infrastructure, including electricity, are not off the table. Let's get more from Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Thanks very much indeed for joining us.
Thank you.
How are you playing the current uncertainty? Have you changed your weightings?
Well, we've certainly been grinding our cash levels down lower, but certainly I think we're still very much focused on income within our equity mandates. Being defensive has allowed us greater flexibility to navigate this uncertainty and take advantage of some of that near-term noise. But ultimately, I think we are picking up a few opportunities, but there's no one sector or cohort that is really a screaming buy to us. But that said, we have taken the opportunity to trim back on some of the energy names we own, just given where they've climbed.
So what did you say off the top there about your cash levels?
We've been grinding our cash levels lower in recent weeks just to take advantage of some of the declines that we've seen in the markets. I mean, really, I think you have two camps of people in this past month. There's this time it's different, where people are going to sell the cash and put their heads in the sand until they feel better about themselves. Then there's the camp that I tend to be more a part of, which is the ultimately that this too shall pass. The general rule of thumb when there's market weakness from geopolitical uncertainty or events is just about always a buying opportunity when that weakness comes about. And we believe that the markets can handle this near-term disruption and higher energy prices in the near term. Of course, the longer this goes on, the more of a challenge it'll be for the confidence of investors. But my general message is, while the downside can be tough to stick with it, missing out on the eventual good days are far more painful and costly in the long term.
Let's pop up maybe a 10-year chart for the S&P 500, because history does indicate that wars can hurt the market for a good while, but it comes back.
Certainly. I mean, still think that there's reasons for optimism this year in the stock market. Currently, we're seeing from a relative strength basis that stocks may be oversold. I still think that the AI disruption and associated sell-off in software stocks is creating opportunities for some great businesses. And I like just to remind people that great businesses don't suddenly stop being great businesses simply because of a conflict on the other side of the world. I think that great managers and great operators can navigate this and continue the trajectory onwards over the long term.
You have some stock ideas for us. CN Rail, this is one you've been buying lately. You reckon CN Rail has been trading close to its lowest valuation in a decade?
Yes, it's a recent addition for us. It's trading close to its lowest valuation in 10 years at around 18 times earnings today. Its high end historically has been around 26 times. You're picking up a 2.6% dividend today at current prices. Earnings estimates have been on the decline the prior 2 years, but have started to actually trend upwards. And importantly for us, we've actually noticed improved sentiment in the transportation sector, but rails have lagged. And we think the current valuation offers exposure to cyclical recovery and downside protection should that recovery not materialize. And they're a good example of a company that's actually seeing some improved cash flows as well, given some of the capital expenditure plans that have come to fruition the past year, which is freeing up some more opportunity for investment in the business, as well as potential for growing dividends and share buybacks.
You have another idea, Zoetis, which is the big animal health company.
Yeah, global animal health company. They provide everything from medicines and vaccines to diagnostic services and genetic tests for household pets, as well as livestock animals. They operate in over 45 countries, or service 45 countries, I should say. Another recent addition for us, they actually hit a 52-week low last week and are trading currently at their lowest valuation in the past 10 years. We think that the outlook for the animal health industry is rather bullish, with estimates suggesting $20 billion in market growth over the next decade, with Zoetis being the #1 player in the space, which should help them be a long-term beneficiary. Really, I think that they have a very defensible business model, and I say that not just as someone who spent $3,000 on a cat earlier this year. 70% of their revenues come from household animals, and we actually think that the COVID era pet surge will start to translate into more veterinary visits in 2026 onwards, as a lot of those pets are now at least middle age, which tends to drive up the costs of a lot of those animals, of course. And on top of that, too, they have a great pipeline in terms of new medications and vaccines that we think that could help drive some optimism for the stock moving forward.
How is the cat doing? I have to ask.
The cat is fine. Yeah, the cat survived. Thanks to Zoetis.
I have one dog that's on pills, meds, and of course we have to put it inside a bit of food. And her sister has to get a treat as well, and her sister is putting on weight. She's benefiting, riding the bandwagon here. Thank you.
That's how it works. Thank you.
Thanks, Kyle. Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. On Friday on Market Call, we were joined by Brianne Gardner, portfolio manager and senior wealth manager at Velocity Investment Partners at Raymond James. And she was covering North American large caps, and her top picks were Wheaton Precious Metals, WPM. That's one way to play precious metals. Big growth in production, or the equivalent of production, in coming years. IBM, one of the great original players in AI, and Analog Devices, ADI, on the NASDAQ. Today, our guest is Dan Rahinton, VP and Portfolio Manager at IA Global Asset Management, and he'll be taking your questions on Canadian and global large caps. Just before we go, could we possibly put up a stock, GH? It's a game host, and it trades on the TSX, and it looks as though GH for game host. It looks as though yet another company is coming off the TSX. An indigenous-owned outfit called Pure Casino Entertainment is offering to buy it for almost $300 million. And according to the Globe and Mail's Andy Willis, they'll partly pay for it by selling 4 Alberta properties to a U.S. real estate outfit that focuses on owning casinos. And so GameHost owns two Alberta casinos and a pair of adjacent hotels. So there's a deal there in the gambling industry, and GameHost looks like it's coming off the market. Just ahead, we are going to hear from a former U.S. Associate Deputy Energy Secretary who warns that the ongoing Mideast conflict could extend for a prolonged period. That's ahead. A former U.S. Associate Deputy Energy Secretary, Randa Fahmy, warns that the Middle East conflict could extend for a prolonged period. We got perspective from her in a Bloomberg interview, and that's after the Iranian-backed Houthi militants in Yemen entered the conflict over the weekend. She explained what this could mean for oil markets and the global economy.
Not only here in the United States, but certainly throughout Asia, where you are, and Australia. And by the way, it's not just the oil markets. Of course, it's LNG, which many markets are incredibly dependent upon. So it's been an earthquake, as we all know, in Petroleum 101 or Energy 101. When something like this happens, the global oil market is in for a shock. And I don't think anybody didn't predict that Iran has leverage, and the leverage is the Strait of Hormuz. And they will shut, and did shut that down as a result of the escalation and of the war. You know, as far as predicting, and, you know, it's very, very difficult. You know, the markets are nervous, as they should be. We haven't seen the prices rise this high in the global stage for a very long time. People should be nervous because, you know, last week we were talking about just a few more weeks, but I'm in Washington, D.C., and that's not what I'm hearing. I'm hearing this, we might be in for the long run. And there are American troops that have been sent and stationed in the region. The question is there going to be a ground invasion? Are we going to put boots on the ground? Everyone's nervous. And the bottom line here is the decision makers are very unpredictable.
I am curious, because I know you must be having a lot of these conversations. What are you hearing in terms of what does the long run mean? What are the possibilities that are being discussed as potential reality at the moment? And also, how does the widening of this conflict with the proxies impact the broader market?
Yeah, so what I'm hearing initially, obviously, this was a U.S.-Israel war in the beginning. But now our allies in the Middle East are jumping in, either because they've been attacked or because they want to protect their interests, certainly. I think it's incredibly concerning that the Houthis in Yemen, an Iran proxy, have now jumped in. Prior to this, they stayed out of it. Why did they stay out of it? I think because they didn't want people to think that they were beholden to the Iranians. But the reality is they jumped in. And who is it that they're attacking first? The Saudis. And they also, again, are in danger of controlling the Bab el-Mandeb Strait, which again is another choke point for oil exports. And if they close Bab el-Mandeb, then then we're going to have a problem, a major problem with supplies.
Right. And the thing is that they haven't necessarily said that they would target vessels, but just the idea that they could will probably lead to these ship owners not really wanting to send those vessels, right? How long does it take to redraw the shipping routes and maps now that you have to avoid so many different bodies of water?
Well, it's almost impossible for the ship owners and the maritime industry to redraw these maps. They cannot all of a sudden change course. But remember, it wasn't that long ago in March of 2025 when the Houthis were attacking shipping vessels. So they have the ability to do that, certainly, if they want to. And so, it's not that easy to redirect things. And also, if you're a shipping vessel, you're going to avoid that area. Why would you go into harm's way and danger knowing that there's a war going on? So you're going to have many of these large vessels choosing not to go at all because of the risk of danger and the high risk.
When can we expect U.S. shale also to start making a difference? Because even if they start pumping now, the supplies to actually reach the parts that it needs in the global economy would take time.
Yes, absolutely. I mean, anything like shale or powering up here in the United States, we talk about nuclear, we talk about hydrogen and other alternatives. But something like shale, sure, when the market gets nervous, there's all sorts of talk. But it would be very difficult to power up right now and start moving. Look, the reality is we're very well supplied here in the United States. The issue isn't the U.S. And in fact, the administration hasn't hesitated to tap our strategic petroleum reserves. We're not all in that danger. It's all of you and the rest of the world, and back to this global oil market that is becoming difficult. So the reality here in the U.S. isn't supply, it's the price. And we're certainly seeing the price at the gas tank, at the gas stations. And, we have a lot of other pressures here in our economy. We're trying to come out of a recession. There's still problems here with our markets, with our mortgage rates, with our financial systems and whatnot. So, it's added to this, and that's a problem because we're going into elections here in November, and the Republicans who are presently in power, both in the House and Senate and in the White House, are extremely nervous because Americans vote with their pocketbook. Americans look at the economy, and this war is affecting the economy here in the U.S., no question.
Okay, we are going to take a break and we're going to switch topics. We're going to have a look at the $7 trillion robot market. John Ehrlichman is up after the break. The robotics revolution has arrived as companies such as Tesla push a future filled with humanoid robots. Some Wall Street firms see a multi-trillion-dollar market within 2 decades. BNN Bloomberg contributor John Ehrlichman joins us now. John hosts the investing channel Ticker Take on YouTube. John, you just did a video on this. What is the Wall Street take on robotics?
Yeah, we did, Andy. And I was very curious about this subject just because you're right. It's the Wall Street firms that are now putting some pretty big numbers out there. It's almost like they're competing to have the most quoted numbers. A range of firms have put out some eye-popping financial potential over the next, call it, 2 decades. But the one that really stood out to me was Citigroup projecting that by 2050, the robotics market, or more specifically, this world of human-like robots could be a $7 trillion market. And so I think, in the face of a lot of uncertainty and there's geopolitical jitters right now, one has to ask the question, okay, well, for the companies that are positioning for this future, is this hype or is this something that is going to be one of the biggest investment opportunities of all time? Now, you mentioned Tesla, and I think one of the things is that many of the analysts who are looking to sort of ride the wave of where Tesla is going will be the first to talk about the potential of this market. There's firms like Morgan Stanley. Adam Jonas is a longtime analyst there. He's a big believer in this Elon Musk vision that we'll see this market explode over the next couple of decades. And if you think about where we are right now, self-driving cars are coming to roads everywhere. Really, those are machines run by AI. If there is sort of this demand, I suppose, for people to have robots in the house to help them, I don't know, be their friend or clean, maybe this could be a massive market. But I think the easier place to look is just within factories, where a lot of this is already playing out, particularly in China, Andy. And I think there's a number of companies that we don't talk about outside of Tesla, in part because they're just not in sort of the North American zeitgeist, but they're all spending a lot of money to get bigger quick.
And give us some stocks, John, that are coming up in this context.
So I mentioned Tesla. I think the fact that the world is so obsessed with NVIDIA, keep in mind that NVIDIA wants its business to keep humming along. And so they're being very supportive worldwide of companies that want to have brains behind these humanoid robots. So they're investing a lot of money in it. So look at some of the chip companies and also some of the rare earth companies, because all the motors and sensors that go into this as well are going to come from companies like MP Materials and others. So it'll be an area worth watching.
John, thank you very much indeed. Really appreciate it.
Thanks, Andy.
John Ehrlichman. Just ahead, stocks have been hurting this month. Our guest will break down how to navigate this new reality. Welcome to the second hour of the Open. Let's check out the stories we're working on in the BNN Bloomberg newsroom. U.S. President Donald Trump is threatening Iranian energy sites if the Strait of Hormuz is not reopened soon. In a post on social media, Trump said the U.S. would respond by blowing up and obliterating Iran's power plants and oil wells. Trump also said the U.S. would go after Karg Island, a crucial oil infrastructure location, if the strait remains closed. The remarks come after a brief pause in attacks on energy infrastructure as the two countries held talks. Air Canada shares down a little bit today, but of course oil prices have been going up. This chief executive, Michael Russo, is to retire by the end of September after backlash after he released a condolence video for victims of the LaGuardia airport crash in which he didn't speak French. The airline says the search for a new CEO is underway and that the ability to communicate in French will be considered. We are watching shares in Eldorado Gold right now and also Foran Mining. Fairfax Financial is backing a proposed deal between those companies. Fairfax has agreed to vote all of its Foran shares in favor of an acquisition. It owns more than 120 million shares, representing a 22% stake. The deal is worth nearly $4 billion. And the target is to achieve a company with production of about 900,000 gold ounces in 2027. And the TSX Composite holding its own right now. We also saw a higher open for U.S. stocks. Now, it's been an ugly month, as I said, March. As of Friday, the market was down. Both the U.S. and Canadian market was down about 7%. And obviously, the threat of something like stagflation with oil prices going up, but world economic growth slowing, worrying investors. I'm just looking at the very active stocks in Toronto right now. Energy shares are higher. Baytech's up around 2%, Whitecap up around 1%. CIBC holding its own, up about 0.25%. But the big value traders right now in Toronto are the energy names. And let's have a look at the U.S. markets. Once again, did we check those out yet? And of course, the S&P 500 selling off Friday, rebounding a bit today. Nvidia is pretty flat. Micron down about 3%. Amazon up around 1%. Alphabet flat. So no big move in the massive stocks in the United States. These fears about the ongoing war between the US and Israel and Iran are hanging over the market. And of course, if oil continues to go up, that feeds inflation, and there could be reluctance on the part of the Fed to cut borrowing costs. Let's get more from David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. David, great to see you. Thank you very much indeed for joining us. What are you paying most attention to? There's so much going on.
Well, certainly what's going on in Iran is forcing all of Wall Street investors to become geopolitical experts, which is not what they went to school for. It reminds me a little bit of the COVID-19 situation where we were forced to all become epidemiologists. So really what's going to be driving the market, certainly near term, is the development, the negotiations or escalation or de-escalation in the Middle East, particularly between, of course, the United States and Iran. And we just don't know how that's going to shake out. If it goes on longer, of course, oil prices are going to stay higher. And of course, if there's destruction of their oil and energy production facilities, then even after the strait perhaps opens up, there's going to be a longer term shortage. We're seeing the higher prices here. Other countries, for example, in Asia, are actually seeing outright shortages where there's lines and a lack of supply. So it's a very serious situation in addition to, of course, the humanitarian situation. Having said that, what does an investor do here? I think it all depends on your time horizon, Andy.
If you need money within a year, caution is advised. Generally, I think strategists say don't have too much money in stocks if you're going to need the dough in a year's time.
Yeah, I think that's right. Although I can show you a lot of geopolitical situations where the market was actually higher in a lot less time than that, 3 months. Remember, we are at a 7-month low here in the markets. We have seen the stocks come down for about 5 weeks in a row here. The NASDAQ 100 is down about 13%. So we've already have much improved valuations. I believe now the price to earnings ratio forward on the S&P 500 is now slightly under 20, which puts it below its 5-year average, admittedly not below its 10-year average. So I think you're getting closer to a situation where perhaps you could see some returns sooner than a year. But of course, it's always better to be conservative and expect that your time horizon's got to be longer.
You have some stock ideas for us. United Health, it had a wretched year last year. Maybe you could put up a 5-year chart. The health insurers generally suffered. Just remind us, what has been weighing on United Health and why do you see upside?
Yeah, so it's just a massive number of negatives. As you point out quite rightly, it's been shared by all the members in the sector. I think your key drivers here are costs for payouts for patient care have risen much faster than the premiums. So that's, reduced cash flow. In addition to that, there has been new regulations proposed that would drastically, make flat further increases payouts by the government for many of these insurers to pay for care that's ultimately funded by the government. That's been weighing on the whole sector. We don't think that ultimately the proposed 90 basis point increase reflects inflation or reflects reality. And so I think that's just not going to work. But right now, that's discounted into the price. On top of that, of course, you've had a change in the top in terms of the CEO. You had the tragedy about a year and a half ago with one of their executives. and of course, very bad publicity. Having said that, this is the big kahuna in one of the most important sectors in the U.S. economy. As we all get older, healthcare needs are just soaring, and United Healthcare is number one. So ultimately, they are the price setter. They have no choice but to gradually increase those premiums and be very careful about the businesses they remain in, pull back from some businesses, and indeed, they've completely extricated themselves from one state where the economics became unfavorable. So we do think that United Healthcare, now trading at like a 5-year low in terms of valuation with a dividend about 3.4%, and about half of its all-time high, is likely to provide over the next 5 years double-digit returns to investors who can stomach the near-term risks here.
Conagra, a huge player in food, Slim Jim's one of its offerings. You see upside here as well. I mean, these packaged good food companies have suffered.
Yeah, absolutely. So again, we have a whole industry that's down in the dumps, the so-called consumer staples. People worry about people eating less due to GLP-1. People eating healthier due to all sorts of factors there in terms of alcohol consumption. That also is down. Nevertheless, these consumer staples have very steady businesses. And if we do get slowing growth here, people tend to come back to these things which have solid dividends, solid business plans, less risky needs. Conagra is the highest dividend yielder now on the S&P 500 at just over 9%.
Wow.
But our work suggests that indeed that dividend is covered adequately, and we think that through skillful management of their business, they can continue to grow earnings and continue to cover that dividend. Meanwhile, you have a stock that's down about 30%. Just recently, I think their 52-week high is 26. Now they're around 15. We think you can get nice double-digit returns going forward, and particularly this should be in your portfolio if you're worried about economic growth going forward because of what's happening in the Middle East.
A 9% dividend yield. That's pretty lofty. David, we better leave it there. You gave us some fascinating ideas. Great hearing from you.
Thank you, Andy.
David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. Coming up, Porter Airlines is laying out ambitious growth plans. Let's find out where it's expanding and what this means for competition in the airline industry. That's ahead. Porter Airlines plans expansion and a bigger fleet. It's also adding routes, new destinations. The company has teamed up with Macquarie Asset Management on a multi-million-dollar investment to build and operate a new terminal in Montreal. We got more from Michael Deleuze, CEO of Porter Airlines. We kick things off, though, by getting his reaction to news that Michael Rousseau, the CEO of Air Canada, is stepping down.
I had a lot of respect for Michael Rousseau. I thought he did a great job at Air Canada, and it's unfortunate, sort of the recent events that really led to this. But Michael did a very strong job leading Air Canada, and the recent sort of events are unfortunate.
Okay, and let's talk about what's happening with Porter. Montreal Airport, you're getting ready to take off in June. What are we going to see coming out of that airport? That's an ambitious project.
So last Tuesday, we opened to the media the new terminal at Montreal Metropolitan Airport, also known as the Met. And it is the single most ambitious launch of a new airport by any airline in this country. We are starting on June 15th, 12 new destinations, all in the first week of operations with 138 flights. And the Met terminal and its location will transform air travel in Montreal. The airport is conveniently located for 50% of the residents of Montreal. It's a faster on-the-ground drive time to the Met. But for visitors coming into Montreal, this is a much easier way to get to downtown Montreal. And you can see on the photos you're showing that, much like the Billy Bishop Airport, which we developed back in 2006, this is a comfortable business class lounge type environment for all passengers, regardless of fare type or which airline you travel with. and it will truly transform and make Montreal air travel easy again.
Michael, it's Philip Peterson. I have to ask, with oil prices where they are and jet fuel prices increasing, how is Porter adjusting to this higher price regime?
Well, everyone's watching that closely. We've seen fuel prices rise fairly dramatically over the last month. We are seeing a very strong revenue environment at Porter. Fares are up significantly on average as we continue to see maturation of our route network. But all airlines worldwide are really watching what happens over the coming weeks and months with fuel prices and see if further adjustments are needed.
And going back with Montreal, the airport, the Metropolitan, it's still not officially a Metropolitan, if I'm not mistaken. You're only doing domestic flights. Is that enough? Is there enough volume there for you?
Absolutely. We've launched 12 domestic routes, really coast to coast, Vancouver, Calgary, Edmonton, all the way out to Halifax and St. John's. And I can tell you, we launched sales last Tuesday, and the demand for this airport and an alternative within the Montreal marketplace overwhelmed even our greatest expectations. So there is very strong demand. This clearly is something that would differentiate itself in the market. And eventually over time, as the airport takes hold, the community loves the airport. If there is a desire for us to look at international flying, whether that be to the U.S. or Mexico, Caribbean, that's certainly something we'll look at with all the stakeholders.
Now, how would you be able to get that? I thought Trudeau Airport has the exclusivity for international flights.
Well, back in 1992, they were granted a monopoly over international flying, though. That was in a context where the Met didn't exist. And the Met will be in the marketplace, and really it will divide the city and residents between which airports they each go to. Whenever you have a multi-airport system, people go to the airport that's most convenient to them. And so the context of ADM having a monopoly over international routes, I think will be something that will be discussed quite extensively, because if you live 5 minutes away from the Met, why would you subject yourselves to a 50-minute drive across the city in traffic, both from an environmental ESG perspective, but as well just serving the community? That makes no sense. And so I think the parties will all come together, and there are additional factors as well. Obviously, YUL faces very severe capacity constraints. And so ultimately, relieving some of that pressure is a good thing.
And we've seen this expansion play out over the last couple of years, expanding into Pearson, expanding into Hamilton, not only with more regional routes, but long-haul routes as well. How do you balance or prioritize between the two and when you think about expanding to other areas?
Well, really, we've focused our expansion on Eastern Canada, out of Toronto, Ottawa, Montreal, Halifax, but as well out of Hamilton, as you mentioned, and now serving both Toronto airports and soon to serve both great Montreal airports. Will be the only airline serving both extensively with operations. It is a balance where we dedicate the aircraft resources, but we have taken on a delivery stream of up to 100 Embraer E195-E2 aircraft, which is a state-of-the-art narrow-body aircraft that allows this expansion to really touch all of North America from Eastern Canada.
And now going to Billy Bishop in Toronto, the province has said it wants to take over the city's portion of it. You have long pushed for jets there. With the Portlands developing, how do you balance those two things in that city? Because any jets coming in, if I'm not mistaken, would have an impact on any kind of development in the Portlands.
Well, development in the city has certainly coexisted with the airport for many years. Nothing will change with regards to that. Whether jets are allowed or not allowed at Billy Bishop, the same parameters exist between development and the airport. Flight paths are protected, and so jets has no downward impact on development of the city compared to what exists today. And the Billy Bishop Airport is a clear economic driver for the city of Toronto. Over 90% of residents are highly supportive of the airport, and the province recognized that it is a key economic driver not only for the city of Toronto but for the province of Ontario, and really that's why you saw them step in last week with some changes to the overall governance structure of the airport.
All right, one last question. Talk of an IPO, is that talk, or is that something that may be happening?
Right now, we're focused on executing on our growth plan. We're fully financed. So it's not an imminent IPO, but it's something that in the longer term horizon, of course, we'll eventually look at.
Okay, and of course, they're trying to start talking to experts about the noise from jets, if they allow them at Billy Bishop Airport. And the experts saying there'll be those new planes, they're not whisper jets, they'll be at least as loud and possibly louder, because we don't have enough noise in downtown Toronto with the garbage trucks and the rubble trucks. Coming up, we're going to check out some of today's notable calls, including Netflix. Let's check out some notable analyst calls. Citizens is rating Netflix at hold, starting off with a market perform rating on the streaming giant. Citizens argues that the streaming company has limited upside potential. The analyst Matthew Gordon says that there are few near-term catalysts and we are awaiting a better entry point. We see the shares as fairly valued. Now, the stock has bounced lately. It's up more than 20% off a low in February. And RBC analyst Jimmy Shan is lowering the firm's target price on Colliers International to $160 from $180, but sticking with an outperform rating on the shares after meeting with the management team. RBC says, or the company apparently remains cautiously optimistic across all segments, although rate increases can have an impact if they persist, the analyst tells investors in a research note. RBC argues that the valuation remains attractive, but heightened economic uncertainty, including the impact of AI, may continue to weigh on the stock. And let's have a look at AGT Food and Ingredients. It just went public again. About a month ago, the IPO was priced at $23. You can see the stock is down from that level. TD is starting coverage with a cautious note, market perform, a hold on AGT Foods. The analyst over there, analysts including Derek Lassard, arguing that the company has grown its revenue and expanded margins since it went private in 2019. However, we see limited near-term upside due to a lower margin profile and weaker free cash flow conversion relative to processor peers. And so TD coming out with a lukewarm verdict on AGT stock for now. Coming up, we are going to bring you the latest headlines and update you on those markets. You are watching BNN Bloomberg. U.S. President Donald Trump is threatening Iranian energy sites if the Strait of Hormuz is not reopened soon. In a post on social media, Trump said the U.S. would respond by blowing up and obliterating Iran's electricity plants and oil wells. And he also indicated they could go after Karg Island, a crucial location for oil infrastructure, if the strait remains closed. Those remarks come after a brief pause in attacks on energy infrastructure as the two countries held talks. And Trump himself says that the new regime, slightly changed regime in Iran under a new supreme leader is more reasonable to deal with. Aluminum stocks jumping. That's after Iran's attacks on major Middle Eastern aluminum facilities. The move has been raising concerns that the already fragile market will plummet into a crisis and push aluminum prices to record highs. Some experts think the strikes raise the risk that the impact on global production will persist long after the Strait of Hormuz is reopened, possibly forcing factories into temporary shutdowns. Bloomberg News says the federal government is working with Quebec to prevent the closure of Canada's only copper smelter. That's after Glencore threatened to shut it down over new pollution control requirements. Last month, the company suspended plans to invest nearly $1 billion US in its Quebec operations after talks on cutting arsenic emissions collapsed. Quebec is now proposing legislative changes to address some of Glencore's concerns. There's a look at the US markets and Toronto. You can see the NASDAQ now flat, S&P 500 eking out a gain, and Toronto up about 0.5%. This follows the pretty savage sell-off on a Friday. Let's have a look at oil. Oil is up around 50% and more this month alone. And US heating oil has soared far more, something like 70%. Of course, we are moving out of heating oil season, but the impact at the US gasoline pump must be weighing on Republican politicians' minds right now. And let's have a look at gold. Gold, of course, has not acted as much of a hedge or flight to safety commodity during the current conflict. RBC reckons that investors seeking a hedge have instead moved into energy. The City of Toronto has voted to move forward with a controversial new idea to try to cut costs of groceries with, quote, not-for-profit city-run grocery stores. That idea has gained momentum since New York's newly elected mayor brought it forward. But as CTV News colleague Camille Caramali tells us, there are those who believe the pilot project is destined to fail.
I'll put that right there. It was an idea served up by New York Mayor Zoran Mamdani that's been gaining momentum. Not-for-profit, city-run grocery stores.
Motion 4A carries the...
Now, the City of Toronto voted Thursday to become one of the first in North America to test out municipally operated grocery stores, 4 locations, meant to create more competition against the privately owned grocery giants by offering food items at a subsidized price.
To ensure that the lowest possible food prices are attained.
Grocery shoppers with an appetite to try anything to cut food costs.
I think anything that we try that's innovative, and if it works, why not?
Just ask Maria Sanchez, who struggles every week to afford quality foods.
I'm a single mother, and it's just hard to find good, especially products.
But there's a belief the city is biting off more than it can chew, with profit margins for food already razor thin.
Every dollar that you put through at the till, there's about 4 cents that is coming back as profit. Can they match the purchasing power and the efficiency of the for-profit sector and then deliver it without that profit motive?
Other Canadian cities watching closely, Ottawa has its staff exploring the idea.
There are people that are very positive towards it, and there are people that are very much against it.
While Vancouver councillors instead wanting to put more money into already existing independent grocers and co-ops.
And allow them to do what they already know how to do rather than us step in and try and take over in something that we have absolutely no expertise in.
Toronto City staff are expected to report back to council with a plan a year from now in spring of 2027. So it'll still be some time until we see these city-run grocery stores turn into a reality.
CTV's Camille Caramali. Okay, Canada's tourism industry is struggling to find workers as employers face tighter rules on foreign labour, and fewer Canadians are stepping into the industry. But Alberta's mountain tourism hotspots are finding that the challenge is even more complex. CTV's Kathy Lee has more on the unique pressures making it harder for those Alberta mountain paradises to fill jobs.
What kind of work are you looking for?
Just days after arriving in Banff from Lithuania, Kantara Daumantaita is already at a job fair.
My goal is to get a seasonal job, a summer job, and stay for whatever the time takes for that job.
She's one of hundreds here, many on work visas, seeking positions in the tourist mountain town. And those looking to hire for the upcoming summer rush, like Brandy White,
I'm just going to create a new folder and
really need help.
I'm desperate. I have to find at least 35
people before June 1st.
Job seekers also include some Canadians, like Jimmy Stevens from nearby Canmore.
I have 2 part-time jobs that are great jobs and everything, but we're struggling to pay the bills every month.
With the number of people expected at the job fair, there is an appetite for people to come here and work. But employers and job seekers say one of the biggest challenges of working in this area is affordable housing. Sergio Garcia, head chef for Juniper Hotel Bistro in Banff, says with record tourism levels, the need for staff is rising.
We do offer housing.
Is there enough?
That's the problem. Now it's not enough.
Canmore and Banff both face extreme housing shortages driven by high demand and limited supply. For many, the cost is out of reach, which means local recruits are hard to come by.
We are trying to hire Canadians. Anybody that's Canadian that's looking for a job, please come see me. We just can't find enough.
White says temporary foreign workers are essential, but tighter rules on foreign labor in Canada and slow approvals make it challenging to bring them in. As for affordable housing, there are plans to increase capacity in both towns. Kathy Lee, CTV News, Banff.
Coming up, hot picks, and we are going to zero in on 3 plays in the pharma sector. On Hot Picks today, we are zeroing in on the pharmaceutical sector. Our guest has Merck as his top idea. Let's get more from Evan Seigerman, Managing Director and Head of Healthcare Research at BMO. Evan, thanks very much indeed for joining us.
Thank you for having me.
Merck, of course, has this overhang. They're going to lose exclusivity on Keytruda, the lucrative drug. Is that weighing on investors' minds?
So it is, but it's, they're doing a very good job to solve for that. So let's talk through why we like this name. First of all, it's not going to be falling off a cliff. It's going to be more of a glide path down. But Merck management has done an excellent job recently of dealing with that. They've done acquisitions. They have had some really interesting data at the ACC, the American College of Cardiology meeting this weekend in New Orleans. And they're basically putting together a constellation of assets to help maybe not necessarily grow rapidly through that LOE, but definitely stabilize their earnings and revenue. We like the recent proposed acquisition of Terns Pharmaceuticals. We think that was a great deal at about $6 billion, could be a multi-billion-dollar asset in the early 2030s. So all in, while pharmaceuticals always have those LOEs, we like what management is doing to solve for the issue that all these companies run into.
And what do they get with that Terns acquisition?
They get a drug for a rare type of leukemia. We saw some really good data at the hematology meeting back in December. And with that, it could potentially move into earlier lines of treatment, very competitive in the space. It's a small molecule, very easy to give, has had some fantastic efficacy.
Can you remind us, has Merck made progress in the area of obesity/diet drugs?
So they're actually not indexing to obesity and diet drugs. And I think that's why some investors actually prefer the name and why we actually prefer it. While we do like Lilly, we've talked a lot about it on this program. I think it's important to have investments in the pharmaceutical space that aren't so tied to obesity. I think Lilly and Novo will be the winners there, and it's really hard for an entrant to really make progress. They have some assets in the cardiovascular space, but not indexed specifically to obesity.
Right. Your next idea is Disc Medicine. Yes. The symbol is IRON, I-R-O-N. Remind us what they do.
For sure. So they are a smaller biotech name. They were actually kind of at the, not really involved in controversy, but they were awarded the commissioner's priority review voucher for the review of their lead drug, bitopertin. Unfortunately, it was surprisingly rejected, but do not fear. They have the requisite phase 3 data coming later this year. They just announced over-enrollment of the trial, which is a good sign in our view. We think that they could have this drug on the market by next year. And beyond that, they have drugs also for other rare types of blood conditions called PV and MF. all in, in the small biotech space, kind of along the lines of Terns, but not in cancer per se. They're niche, but really could add multi-billion dollars to a big pharma portfolio. So we think that at some point they could be taken out.
And people are keen to enroll in the latest trial?
Well, actually, the trial is enrolled completely for their phase 3 trial for bitopertin. It's a rare disease called EPP. Essentially, it's this vampire condition where because of a toxic metabolite in your blood, you have very bad kind of reaction to sunlight. And this drug really helps these patients. It's an easy to take pill and could be, it's a rare disease. So there are thousands of patients. So there's a high potential price tag. So it's an easy drug to market. But the drug works very well and is very safe.
And Regeneron, and they are active in this GLP-1 area as well. But remind us what their drug is doing, though, please.
Yes, but that's not the reason why we like the name. So I'll touch on GLP-1s in a second.
Sure.
But we like the name because they have a growing oncology business with a key catalyst coming in the first half of this year. And we're positive on it. It's a drug for metastatic melanoma. We think that it's going to be successful versus kind of the standard of care out there. They do have some efforts in obesity. They have a GLP-1 GIP that they licensed from China, but they're also looking at the muscle preservation component of weight loss. But beyond that, they have assets in immunology and, of course, ophthalmology. And that's why we really like the name. And, of course, we would be reticent to, ignore Dupixent and what comes beyond that. That's their blockbuster partner with Sanofi.
Sorry, what was that last product that you mentioned, Evan?
It's Dupixent. It's their blockbuster product partnered with Sanofi for atopic dermatitis and asthma.
Thank you very much, Evan. You always give us ideas. Really appreciate it.
My pleasure. Have a great one.
Evan Siegerman, Head of Healthcare Research at BMO. We have lots more. Thanks for tuning into The Open this morning. Former OpenAI executive Zach Cass thinks that while it's still early days for artificial intelligence investing, AI is going to produce a lot of winners. He spoke to our Bloomberg partners, who began by asking him for his thoughts on the risk that we're in an AI bubble.
I will say I've sat here in sort of proverbially this chair for quite a while and defended the economic state of investment in artificial intelligence on a macro basis, which is fitting because I'm at Citi's macro conference. Picking a given stock has never been easy in any chapter. It certainly seems very hard today. There are some safe bets you could imagine, but I think broadly speaking, what we should expect is that AI as a technology is going to make a lot of winners, and some of them are obvious and some of them probably haven't yet presented. There's a new argument to be made, which is that everything is so bullish it's now bearish. If technology continues to improve at the current rate, it does actually call into question a lot of the things that we have considered valuable and whether or not they will actually deflate in cost and therefore value over time. But I will say again, as I have said before, we are still scratching the surface of what this technology is capable of, and I think if you're in the arena, you're going to do well.
The question really is whether you choose the Chinese or the Western models. I mean, in terms of capability differences and gaps, how are you assessing the two?
The Chinese approach is particularly interesting because China had to take a more innovative approach to building its models, in part because it was chip constrained, and innovation is bred in large part by scarcity, and in this case, the scarcity of chips led to DeepSeek's major breakthrough. And in January last year, I sat at UBS's summit and said something very similar, which is watch the world for DeepSeek. And in May, the model dropped, and I think we should expect more and more open source technology from China, from the East, that is driven largely by just needing and less availability of compute. And ultimately, what you then have to ask is, okay, well, what does the diminishing model return theory say? And at some point, the next model won't matter. And the question is whether open source technology can keep up with closed source technology to arrive at the place where we have, truly a diminishing model return. at least for a little while, the frontier model matters, especially if you're building novel sciences. And so China's approach has been to create a bunch of open source technology that the average company can use quite effectively and compete on energy, which they're doing quite well. In the West, we're going to continue to see the frontier models come out, and whether or not those frontier models start really moving the needle in things like novel sciences is probably one of the major determinants of which side wins.
Zach, where do you see China innovating where the West isn't really paying attention to?
I mean, I don't know that I think it seems a poorly kept secret, but China's clearly winning right now on energy and maybe other novel sciences. But, China's approach has been, let's flood the market with low-cost AI. Let's make AI a commodity as best we can, and let's win on energy and infrastructure. And if you believe that AI will eventually commoditize, utilize completely, again, the diminishing model return theory says it will, that at some point it's the infrastructure that actually can take advantage of the technology that will determine the winner. And 40,000 miles of high-speed rail, incredible amounts of energy capacity. Eventually, at some point, there are other infrastructure that will determine winners. But that assumes that the frontier model is not critical for a long time, and that's not a safe assumption.
Zach, I want to talk about what people are talking about right now, which is the existential threat of AI. You say there is no such thing, but we've been hearing from a lot of, the big voices in tech that, these super intelligent systems will be uncontrollable at some stage, that, humankind will disappear. Where are you with that argument? Where are you with that debate?
Well, Haslinda, I want to be clear. I do not make the case that there is no such thing as an existential threat that AI presents. And in fact, I'm very willing to acknowledge the existential threat that any novel technology that's moving this quickly presents, especially its ability to empower low-resource bad actors to do more and more harm. My point, when I talk to audiences and when I talk to leaders, is that there is first, that those risks are actually fewer and more concentrated, and also that there are clear and present risks that we are not talking about when we make the conversation about doom and gloom. And that there are greater risks that we sort of are presented with today that we will need to tackle probably long before we ask, is the world going to end because of AI? One of those risks is cognitive surrender, or what I call in the book idiocracy. Are people getting dumber because they don't have to critically think anymore? Another is dehumanization, or people finding more interest in virtual and digital realities than physical ones. Another is identity displacement. I think that there is this impending threat that automation actually creates an economic boon, and a bunch of people are left asking, well, what do I do? There may be more and better food on the table, and people may be emotionally aggrieved to the extent that they can't even celebrate it. And I think that we're not talking about these issues because we're so wrapped up talking about what happens when Terminator shows up. And I think that we will have to graduate a lot of problems to get there.
And we also talk a lot about AGI timelines. I mean, how should we be thinking about AGI timelines, to make it useful for decision makers today?
I am very willing at this point to say we're at AGI. I mean, partly provocatively because the AGI point was always a marketing speak. It was always designed as an idea that presented people with actually the concept that we're at today. What happens when agents can do a lot of stuff? That was impossible for people to grok in 2019 when we started talking about it in 2020 or 2021. By many measures, we've arrived at AGI by sort of the loosest definition. Now, the problem is AGI is not a thing that you can actually, there's no AGI test. Sam Altman himself said at some point we will be at AGI and no one will notice. Things will just start getting cheaper and we'll start discovering new drugs and new sciences. Superintelligence, which is the new marker because people have moved on from AGI, that one is a more interesting question, and that sort of borrows from Ray Kurzweil's singularity. When does the model start training itself? At what point, is the machine just so much smarter than we are that it can do lots more things? I think we are a long ways from that, and Jan LeCun and Fei-Fei Li are building world model companies principally around the argument that the current LLMs, the architecture itself, will have a very short runway against superintelligence. for now, look, we're not going to have autonomous vehicles filling the streets for another 20 years. There's just a lot of stuff that needs to be updated well outside of the actual underlying research.
You talk about Sam Altman from your time at OpenAI. What should we be paying attention to in terms of, strategic patterns to show where the company's headed from here?
Well, you know what I know, and you probably know more. I have a lot of dear friends there, and I mean, I will say, I think the people inside these industries are actually quite wonderful. And broadly speaking, I think that the trouble with the industry is that it is so smart that it has done a poor job explaining itself. Not that it actually is, as misanthropic as it's claimed to be. Right now, I think what you're seeing, though, is incredible amounts of surface area that are now sort of coming back into shape and form. The research companies became application companies, became platform companies, and now the platforms are starting to contract a little to become, more strictly applications. You saw some announcements recently around less science projects. My expectation is we're going to see the battlegrounds take shape around enterprise and consumer in very specific ways, and the applications largely be built around those things.
So he referred there to identity displacement, and apparently psychologists there mean that a lot of us have our sense of self-worth and our identity tied up in our job. Say you're a lawyer who sees AI just wiping out your ability to draw up contracts accurately, doing it far better and far quicker. You're left with the question, who am I? Who am I? So that's identity displacement. Sounds scary, and possibly it is. That was our Bloomberg partners talking to one of the big players in AI, former OpenAI executive Zach Cass. Let's have a quick look at one or two tech names. Celestica weighing on the market right now in Toronto on the tech sector. The chair, Michael Wilson, is set to retire. And you can see that stock is well off its highs, but still up threefold in the past year. So investors don't have much to complain about. Speaking of executive departures, Air Canada CEO is going to step down by the end of Q3 after failing to use French in a condolence message after the fatal crash at LaGuardia in New York. And he drew criticism from the Prime Minister and others for that language slip. It wasn't the first time in which he had attracted criticism for failing to use French. Let's have a look at Aecon. A couple of brokerages, ATB and BMO, saying you should hold this stock because it looks expensive and it's had quite the run. Look at that, up more than 140% in the past year, partly because of optimism over the company's nuclear business. ATB upgrading Vermilion to a buy, saying the stock is cheap, and also it's set for a big improvement in free cash flow generation. Let's check out the U.S. markets right now. We saw ugly selling at the end of last week. They are posting modest gains right now. The NASDAQ barely up, but the S&P up about 0.25%. And let's jump over to oil, because we saw oil in early trading topping $100. Yep, it's holding that level, up 3%. So oil trading at multi-year highs. Maybe we can put up a 5-year chart for oil. And this points to inflation, points to economic disruption when you get a rapid increase in energy prices like this. And finally, gold. The gold bugs have been disappointed by gold, which has not acted as a safe haven in the current crisis in the Middle East, or the current violence in the Middle East. And as I mentioned earlier, RBC reckons that investors have been using energy as a hedge instead. Thank you very much for watching The Open. Morning Markets is up next.